All right, we're going to get things kicked off here. We still got some people rolling in, but this will be a recorded session, so we're going to distribute this out to everyone after we get through the slideshow. So thank you for attending today. My name is Ryan Staton. I am the managing partner and director of planning here at StatonWalsh. For those of you who have not dialed into our quarterly market updates, we do these several times throughout the year. Just want to give you an update on what's going on in the world, specifically around financial markets, economic data, and then also just give you some tips and insights and how to proceed in your own investment portfolios as the year goes on. So for those that have listened in to some of our webinars, you'll know that I always like to start things off on a lighter note. And try to find some kind of representation of what's going on in the world today. And so right now, I think what we find ourselves in is this point of uncertainty with where are we in the market cycle. Lots of talks about recession, bull markets, bear markets, a lot of industry jargon and terms being thrown out there, and really hard to make sense of what's going on for an individual investor. And so what we want to do is provide some clarity there and give our 2 cents on where we think the market is going and also what what you can do as an investor to stay on top of that and make sure that your portfolio is still working for you the way that you would like it to. And so little cartoon here, bull market, bear market, where are we? And no one has a concrete answer on that, but it is certainly something that gets a lot of attention and is up for debate in today's market cycle. So what happened over the first quarter of the year? The U.S. major market index performance is listed up here on the screen. So the 3 that we most commonly look at and that most investors look at are the NASDAQ, S&P 500, and the Dow Jones. What's happened the first part of this year is a pretty big comeback in the terms of the NASDAQ composite, which is made up largely of growth focus or a lot of tech firms. And that was an index that got beat up pretty bad last year. And so what we're seeing is somewhat of a reversal to that. And though that index in particular is starting to grind back into positive territory, we also saw the S&P 500 total return climb about 7.5%, and the outperformer for 2022 was the Dow Jones Industrial, a much more modest number there in the first quarter, growing just under 1%. In international markets, we saw a pretty good amount of growth in most of the sectors, but the representation here is really a total market perspective, basically the entire world with the exception of the US. The EAFE, so more established companies, developed markets, think Europe and the like. And then we have emerging markets, which are your smaller countries around the world that are growing economies that are not necessarily part of, in a big way, global trade. And so all 3 of those particular indices grew, 2 of which outpaced the S&P 500 from a U.S. market perspective, and 1 of which has grown. Emerging markets has grown moderately, but still underperformed U.S. markets in several sectors. So all in all, what we're seeing, the trend, not just in the U.S. but around the world for the first quarter of 2023, is that we're seeing some growth. We're seeing a little bit of a rebound and coming back to the surface from a rough year in 2022. So to break it down a little bit further, one thing we look at in the US is sector performance. And so the different sectors that we're talking about are described there on the right side of the screen. And so industries like technology, communications, healthcare, real estate, financial sector. And what you can see is that each one of them had their own experience. But on the first slide, when we talked about the NASDAQ composite, heavily driven by tech and communication companies. And as you can see there, that was reflected in sector performance. Some underperformers for the first quarter of the year, the financial sector, specifically a lot going on with that. Rising interest rate environment, tightening in lending facilities, some bank turmoil going on, which we'll talk a little bit about later in the presentation. But a pretty wide spread here from performance between the different sectors. And when we get into some of the macroeconomic data, we'll talk a little bit about why some of these have performed better than others. Some, like the energy sector, and specifically when we talk about commodities, for example, those outperformed significantly last year. Those are ones that are now underperforming the bulk of the market. So we'll unpack that a little bit more in a later slide, but some interesting insights and some interesting reversals of where we saw ourselves, this time last year. So let's talk a little bit about asset class returns. So asset class in general, think growth, certain types of assets like US Treasuries, real estate, different sections of the market. You see commodities there as well. And so if we look all the way to the right of this chart, we see a larger trend of US growth really being the outperformer and one that's dominated over the past 10 years. Last year, we saw that in a pullback in a major way, and value took center stage when we talk about different types of US equities. Commodities ultimately was the best performer. But when we look at where we are today versus where we were last year, US growth has reemerged as a top performer. And so year to date, it is the largest performer, followed by pretty much the rest of the world, then the S&P 500, and you can see the list going down from there. Commodities, which was the belle of the ball last year, is now at the bottom of the list. And so what we see, and something that we haven't seen probably for the preceding 10 or so years, was that the cyclical nature of the market, takes effect from time to time. And so there are going to be some asset classes that do well at certain times and some that don't. And what we saw, pre-COVID really, and even, parts after the pandemic, was that growth had really dominated market performance for a very long time. That took a backseat temporarily, and it's kind of made its way back to the top of the list. But all of this is really a case for, long term, you have to talk about the concept of diversification and how investors are focused in their portfolios and how that really relates to rate of return and performance. What you'll see here is that, when we go down the list in this chart, US growth has been dominant over the first quarter of this year. For sure. But, if we zoom out a little bit, we'll also see that at different periods of time, it was not the best performer, especially when we look at that 1 year total return chart. So a good representation of what's going on, but certainly not an indication of, where investors should be reallocating their money in the short term. So let's talk a little bit about, I mentioned the word diversification and a diversified portfolio. So what does that really mean? Really, we're just talking about a mix of different types of investments, from risky or equity-based investments all the way down to your most conservative, even defensive investments like cash, certain types of bonds, and the like. And so this is a look backwards at, over the past year, what's really happened in a diversified portfolio. And what we'll see is that the best performer in the context of how things have shaped out over the past trailing 12 months has been a relatively conservative approach. So if you were aggressive in any way, the old adage of more risk, more return certainly makes sense over the long term. In the short term, what we've seen is that hasn't really played out. One big reason we see the S&P 500 index is the worst performer in that time frame on this chart, so all the way down there at the bottom with the negative 8.78% return. And so, what does this all mean? Let's put this into layman's terms. The reality is that diversification is important, and we don't know what period of time we're entering into from a market cycle perspective. The market is a predictor of what they think is going to happen, or what we think collectively is going to happen in the future. And so without knowing that, when we look on a year-to-year basis, some diversified portfolios look more attractive than others. But if we zoom out on that, what we'll see is that over the long term, the driving performance or the driving indication of performance is the ability to diversify a portfolio and really stay diversified. And so, this really brings together the data from the previous chart of we never know which basket to put our eggs in because they're all going to be, each asset class is going to be different at different points in time. But if we just look in a short period of time, we can see that there are clear winners and losers. And so the moral of the story is diversification is key, but also being willing to zoom out and see the big picture is another piece of this puzzle, because for those that were relatively conservative during this time, they outperformed others. That's hard to predict that would have been, if you had asked someone a year ago, would a 20/80 portfolio be the highest performing portfolio in a mix of our pool of clients? And we probably would have said, I don't think so, but here we are. So it's hard to predict the future, but more importantly, matching your risk to the level of diversification that you ultimately take is an important piece of this formula. So that's a lot about the investment component, and we'll get a little bit more into investment outlook. But the next thing I wanted to dive into was macroeconomic data. So what's going on out there in the world? And so one big piece of macroeconomic data that we look at is US housing. Where are mortgage rates? What are the origination rates look like? Also, what's the data on consumer sentiment around housing? What's the data on actual housing in general in terms of house prices, housing starts, building permits? These can all be indications of economic strength and where things are headed. And so what we'll see, top left chart, when we talk about mortgage rates, is that mortgage rates, in terms, not traditionally speaking, if we look at historical, but if we look at recent history, still relatively high compared to what we saw in 2019, 2020, 2021, and even the beginning parts of 22. We peaked at a high of 7.08 on 30-year fixed rate. Now we're floating around mid sixes. I actually saw today some of those rates are up in like the 6.75 range. So still relatively high. What we're seeing is that home prices are coming down, but not at a proportional rate compared to the interest rates that people are paying. And so, what does that mean? The reality is that the same house you would have bought this time last year has not changed much in price. However, the cost of owning that home has increased significantly. And so what we're seeing right now is that still relatively low inventory in terms of houses sold. It is increasing, but there's a lot of buyers out there, not a lot of sellers, and there's significant challenges with financing, especially when you get into larger price points and even some of the lower price points. I mean, the cost of a $400,000 mortgage is, I think, nearly double at this point compared to what it was this time last year. So that's a significant change, and that could be the difference between qualification or disqualification when you're talking about people buying homes. The demographic that we're seeing, pretty heavily affected by this are certainly areas where economic growth and activity have underperformed other parts of the country, like places outside of metropolitan areas, but also specific demographics of age and generational wealth. We're seeing a lot more clients and also a lot more people just in general out there needing help or needing assistance with buying a home. And so we're seeing, Gen Y and Gen Z buying less homes and sticking with renting. The rental market has certainly, become more attractive for some of those folks. And so it's something to keep an eye on and something that we look at from time to time to see, like, where are the metrics, what's coming? Is this an indication of what's to come if US housing starts or permits are lower or significantly lower? what does that mean for home prices? Does that mean that they still continue to increase? Obviously, a decreasing mortgage rate environment can also affect activity in the marketplace in terms of price activity and how that shapes out. As you can see, traffic on prospective buyers, single family home sale conditions, the housing market index as a whole, all negative in terms of percentages there in that top right chart. So a lot to be determined, I guess, when we talk about the housing market in general. It has not played out, I think, the way that everyone thought it would when rapidly rising interest rates, proportional reduction in home prices. That just hasn't played out. There still seems to be a bit of an inventory issue, and also still some competitiveness in the buying market, especially for younger families, moving away from metropolitan areas into suburbs. So let's talk about what was the hottest topic on TV, and it hasn't necessarily gone away, but we've definitely we've seen the noise die down around inflation, partially because it's been reduced significantly. We had a peak up in the 9s. We've come down, and so there's a couple different measures of inflation. Excuse me. We have the U.S. inflation rate, and then we have the core inflation rate, which is really a representation of inflation of goods and services, with the exception of things like food and energy. And we've seen costs of some of those things come down. We're also seeing that, and why I put this on here, the big focus around inflation is, what is the Federal Reserve going to do? How much are they going to increase rates? When is enough enough? When are they going to stop? Right now, the upper limit of the target federal funds rate seems to be 5%. There are questions around whether they will continue to raise rates and at what pace. That is a complete unknown. There were a lot of economists out there that believe that the last rate hike was unnecessary, but it still happened in a reduced fashion compared to some of the other rate hikes. But these are things that are going to directly affect consumers in many different ways. And so these are things that will be important economic drivers moving forward when we talk about the idea of recession, not recession, and also how people are particularly affected. Something that we talk a lot about as well is that inflation data in general is a metric. It's a blanket metric, and I would argue that for some of us, the true inflation rate that we experience is very different. For example, if you own a business and you buy certain materials, those may be much more expensive. The inflation rate on that may be much higher than 5 or 5.5%. It may be 10. We see this a lot at the grocery stores or during different periods of time. I know in my house, for example, the price of eggs was a big point of contention, because I have, myself, my wife, and my kids, and we all eat eggs pretty much every day for breakfast. And the cost of a dozen eggs went from like a couple bucks to $6 seemingly overnight. And so, to some degree, the rate of inflation that we all individually experience based on our patterns and how we spend money is going to look and feel very different. But as a whole, when we talk about the Federal Reserve and their metric of how they're going to raise rates moving forward and using inflation as a driver of that, they're going to be paying close attention to these particular metrics, whether that's your true rate of inflation or not. And so as we start to see inflation come down, more pullback in certain parts of the economy, we also anticipate that rate hikes will slow or even pause. And then eventually at some point, either later this year, probably early next year, it seems, there will be some pullback in what the federal funds rate is moving forward. We'll see how that all plays out. But the moral of the story is that I think it's a little bit of a guessing game right now. We're not all really sure where they're going to head, and everyone is kind of sitting on pins and needles every time Jerome Powell does a press conference. And so we shall see how that plays out with the next proposed rate hike or lack thereof. One thing that we look at too, as far as economic data, when you talk about unemployment, labor participation, So this is a bit of a historical chart, but what you'll see is that that gray bar there is representative of the recession, although temporary, that did happen during the beginning of the pandemic. And what you'll see is a direct relationship between unemployment rates and labor force participation in this particular chart. But these are two metrics that become important when we talk about long-term economic strength. Right now, we have an unemployment rate that is historically low. There are jobs out there for people that want to work. We're hearing a lot on our side of the world of employers having a hard time hiring people and finding people to fill positions. And so that is something that is going to be interesting moving forward. That's certainly driving pressures on things like wage growth and companies really kind of being strong-armed into paying a little bit more to pull talent away from competitors or just to attract and retain new talent in their organization. Labor force participation kind of floating around historical rate, still a little bit more work to do there, but we have seen that some people have left the workforce and not returned. A lot of that happened during COVID for a myriad of reasons when we talk about family dynamics and one spouse staying at home to take care of children because of closures of daycare and things like that. And some of those people have returned to work and some have not. Some have just decided not to work anymore, or we have this, they called it the Great Resignation, where people just decided that they were no longer going to be part of the labor force. And so increasing that participation rate is going to be important in order for us to grow as an economy. And so a lot of debate on that in terms of how do we achieve that. Is that through programs that we initiate here at home domestically, or is that through immigration, which in different points in time has been a driver for economic growth and labor force participation specifically. So right now, all looks good from an unemployment rate perspective, but the labor force participation number is one that many economists, I think, are in agreement on. They'd like to see an increase. So let's talk a little bit about interest rate environment. The Federal Reserve has increased rates pretty rapidly over the past year. And so what that has done from an investment perspective has made certain types of fixed income or bond investments more attractive than others, and actually created what we refer to as an inverted yield curve. I will get into what that means specifically and what that means for you as an investor later. But ultimately, what it has done is made shorter term investment vehicles in the fixed income market more attractive than longer term. And so I'll just focus on the very top and the very bottom of this chart. Right now, the rates on a 3-month treasury are about 5.2%. In contrast to the 20-year treasury rate, which is much, much lower than that. And so what does that all mean? And even looking at the 10-year treasury rate, which is something that gets a lot of attention in financial media, the spread or the difference between those two is significant enough that basically you only have to lock your money up for 3 months and you can get a 5.2% interest rate versus locking up for 10 years and getting a 3.58 interest rate. Significant difference. Why does this matter? This is directly driving investor behavior, especially in terms of how investors are deciding to allocate their funds, especially when we talk about fixed income investments, really the conservative portion of their portfolio. But traditionally, this has also been an indication of a recessionary or economic contraction environment. And so these are things that get a lot of focus in the media. And the chart on the right-hand side, I will explain that to you in the simplest way possible. That this is essentially saying that at different points in time where the inverse yield curve or the spread between two types of treasuries, longer term, 10-year and 2-year, get to a certain point where they are inverted or they have this negative relationship, that has been an indication of recession in the past. Will that come to fruition? Possibly. I think there's a consensus that there is some form of recession happening or about to happen from an economic perspective. Most of the time when we talk about it from the market side of things, we figure it out kind of after we're already out of the woods, and the market starts to take its turn prior to a recession, reverting back into some kind of economic expansion or growth environment. So being a leading indicator and a predicting vehicle, the market tends to work in a way that it's going to go down. Recession could possibly happen at that point. By the time we figure out we're in a recession and we're working through how do we get out of that, the market has already kind of turned back into a positive growth trajectory. So interest rates are important because if rates do continue to go up, essentially what we're going to see is a further inversion of the yield curve, and that's going to take away from long-term fixed income investment vehicles, especially like the 20 or 30-year rate vehicles. And also, form an investment policy around how many investors should be postured given, the current rate environment. So let's talk a little bit about the consumer and the state of the consumer. Consumer sentiment is a big one that we look at, and that's basically how do people feel about how confident are people in current economic environment, and what are we seeing? And so what we've seen is that consumer sentiment from its peak in the early 2000s has kind of floated around. We saw during the Great Recession, 2008, 2009, that come back down, went back up again, temporarily decreased during COVID, went back up and got back, kind of reverted back to the averages. And since then, we've made our way down towards the lower end of that band. And I think consumer confidence remains relatively mixed in general. There are, if you ask anyone out there, how do they feel about the economy and or the market, you're going to get mixed reactions. Some are positive, some are relatively negative about that. And so that reflects in the data. I think everyone is in agreement that, some people are really not sure. Some are in a place of financial security. Maybe they bought homes or they did other things prior to, let's say this current rate environment. So directly relating to the bottom third of the chart where we talk about banks' willingness to make consumer installment loans. So that has come down pretty significantly. There's a lot of questions around that. There's a lot, obviously it ties directly into some of the turmoil in the banking industry right now, but also generally speaking, the rate environment, credit worthiness, looking at just the amount of consumer revolving debt. And so those are things that will directly influence banking institutions and whether they're willing to lend or not. If they're not willing to lend and they tighten on that policy, that can cause some economic contraction as well. Certain goods and services that need to be financed may have less of a likelihood to be able to do that. The confidence indicator a little bit below 100 there, showing a weakened confidence. It's not very far off, but in the context of this metric, that is a direct indication that American consumers especially are worried about the concept of recession. And so that can directly affect our ability or our willingness to go out and spend money, which ultimately trickles down to economic growth. So I think we're in a little bit of a limbo right now. There's a lot of uncertainty. Many people are unsure about what's next, and people are certainly in a wait and see posture on when and how they're going to spend money and being more selective on their participation in economic activity. So all the technical stuff aside, let's talk a little bit about investment outlook. So where are we now? This is a snapshot from our weekly market insights. If you get that on a weekly basis, you've already seen this data. If you don't, please feel free to subscribe to it. We send a communication out once a week, just giving you a quick snapshot of what's happened in the market, what's going on, where we are for the week, and then where we are for the year. And so what you'll see, Year to date, some of those numbers have changed. We've been a couple weeks into April, still seeing some growth in various parts of the market, and some pullback in some other areas as well. So the NASDAQ, for example, first quarter of the year was up about 17.5, has pulled back slightly to 15.8. So what you'll see here is that the market as a whole has been relatively positive for the first part of this year up until the end of last week, basically. And so certainly reason for optimism, but also there are some indications out there that we or some things that we need to pay attention to, that we would tell investors to proceed with caution. Certainly don't try to get over your skis in terms of asset reallocation or trying to overweight yourself back into the market, because there are still some things out there lingering that you're going to want to pay attention to. But for the most part, relatively positive start to the year, and a good possibility that some of that will continue. So I talked a little bit about the idea of potential recession and what could be coming or what may already be happening today. This is a chart we used in our last presentation, but I just like to refresh the concept, and really the question is, what does recession mean for my portfolio? And all of these charts combined, what this is a representation of is different points of the market bottom versus when the recession started, when it ended, unemployment rates, and the S&P 500, so broader US market total return. And what we see typically from this chart is that there are some correlations in some years to start of recession, end of recession, market growth, but there's also a lot of times where the data just doesn't really match up completely. And so all that really means is, and all this really is a visual representation of, like, if you're going to try to predict the market, you have to be really good or really lucky. Basically, there is no direct correlation here between the start of a recession, the decline of the market necessarily, and then also the rebound of that. And so, prime example, this one down here in the bottom left-hand corner, we see a market decline. The bottom of the market was actually in October of 2002, but the recession had ended, almost a year prior, officially, from an economic indicator perspective. Then the market started to rebound from there. And so we'll see that at other points that bottoming of the market happened early on in the recession, and then the market charged back through and beyond that recession. Sometimes it happens before, sometimes it happens after. And so there's really no rhyme or reason. In these individual market segments, there are certainly current events that played a role in some of this, but ultimately what I'm getting at is a recession by itself is not necessarily a reason to not invest or to do a complete overhaul of your investment strategy. I think it's an important reason to look at it and make sure that it still aligns with what your financial plan is, but it's not necessarily by itself a reason to change what you're doing. And so the other question we get pretty frequently is, like, should I wait this out? Should I just be conservative? Should I just take my money out of the market, see how things play out, and then, attack this at a different point in time? And so this is probably one of my favorite charts. This is in the JP Morgan Guide to the Markets that comes out quarterly. I think they also do some monthly communications now, but this chart is a representation of intra-year declines. And so what that means is that at some point during each of these years in the market, that red dot was the bottom of the market during that calendar year. And so what you'll see is that there's a few of these years where if you had reacted to, let's say, a negative 19% downturn in the market and said, oh, the run's over, I'm getting out of the market, this is, I need to sit it out and wait and see what happens. What you would have missed is the run up from negative 19 to, finishing the year plus 27. And so the difference between the bottom and the top of that, and that part that happens in the middle, that appreciation that happens in the middle, is ultimately lost rate of return that you will never get back. We call that lost opportunity cost. it's measurable. If you carry that out and project, do like calculations, projecting that into the future, for some, that could be a small amount of money. For others, if we talk about long-term, that could be hundreds of thousands to millions of dollars, depending on the size of your investment portfolio. And so what's my point? I think the point is to have a posture or a investment philosophy based on risk, but also based on what your planning dictates you need to do with your investment portfolio, and sticking to that. Because we'll see, even, when we talk intra-year or year to date, we see a negative 8% number, and now we're at a point where S&P 500 plus +7. So had we gotten out of the market at a certain time and not gotten back in at the right time, trying to play that timing game of money in, money out, it rarely works. I think it's the studies that have been done over the years, like 2% of the time, enhanced rate of return can be achieved by market timing. So it's very rare. It's hard to do. I always tell people that none of us, ourselves included, are that good. We can get lucky, but it's very rare that we're good enough to pick the right time to get out before negative 34 happens, for example, in 2020, like during COVID, the black swan event that no one really knew what was going to happen with that. And then it just happened, and everything, kind of unraveled from there from a market perspective. And then it all bounced back. And by the end of the year, things were looking rosy. So it's hard to predict. I always recommend against it, but there are some that will try, some will succeed, and some will fail. So this chart is a perfect representation of that. One of the things that you'll see here too, as we look at long-term averages, despite an average intra-year drop of 14.3%, annual returns were still positive 32 out of the 43 years in this chart. And so that's pretty compelling data as far as I'm concerned, and something that we really drill down on when we're talking to individual investors about the markets and kind of how to view your investment portfolio. Something else, something that we don't typically talk about, but I'm going to go out on a limb here. This is outside of our typical conversation, but it's one that's getting a lot of traction, and it's mostly because of current events. Banking sector turmoil has driven this buzz around banks, larger banks. Silicon Valley Bank, I believe, was the 15th largest bank in the country. They failed. And so it has reignited a conversation around decentralized banking, decentralized currency. We've seen the Federal Reserve is kicking around ideas around digital currencies and instantaneous transfers. And, banking is trying to connect or catch up with the idea of technology and advancements in technology. And so because of that, what we saw last year was that Bitcoin and Ethereum, two of probably the most popular cryptocurrencies out there, took a massive beating as far as market performance is concerned. And what we saw this year is a big time clawback. We saw a negative 60+% drawdown last year. And what you'll see is that the biggest spike that happened specifically, with both of them really, but more so with Bitcoin, was banking crisis, banking failures, uncertainty around the banking industry as a whole. Cryptocurrency is now viable again. As a currency, this is my personal opinion. So, take that how you'd like. It is not something that people use. It's not usable, spendable currency as far as I'm concerned yet. I know there are some merchants and people out there that do accept it in that way, but it's not widely accepted. It is very much a speculative investment asset, and that's pretty much it. Price appreciation is the driver here. Spendable, usable currency to be determined. These are two of the most popular and probably the two that will have staying power, but crypto is something that is a hot topic once again. And if banks continue to push things to the edge and we see more tightening in financial conditions and banks become less popular or are on the chopping block in terms of, do they stay or do they go? Crypto will begin to dominate the conversation around, is there some staying power in this as a possible use case for spendable money. So what are some things to watch? One in particular is pressure on corporate earnings. One of the things that has been a reason for optimism in the market as a whole in recent history is the fact that corporate earnings and profits were still pretty strong. Q4 last year, we saw some pullback in that, but for the most part, relatively strong in terms of when we look at the total market. A lot of industries had pretty decent profits, but what we're seeing is some strain and some pressure on that. Some of it is inflationary pressure, some of it is wage pressure, companies having to pay more for their workforce, especially for skilled labor or skilled positions, whether it's technical or manual. That has driven decreased potential profits and something that we're definitely keeping a close eye on, because that will affect stock price. I mean, when we talk about it from an investment perspective, earnings reports, what kind of cash flow a company has will ultimately affect the stock price. And then, rising interest rates are also going to take a toll on this. Money is not as cheap as it once was. And so for those that use lending facilities to finance their business, maybe, those that aren't even publicly traded companies are going to feel the pressure there as well on their profit margins. So this is something to keep a close eye on. This will also help or hurt certain investment decisions moving forward, depending on how different companies adapt or react to the environment. But you can see that different industries have become more profitable than others, and some have started to float. When we look at their historical range of profitability, and we see where everyone fell in the fourth quarter last year, some are on the higher end of that range, some are trending towards the lower end of that range. So if those dots continue, those stars or diamonds there continue to move left on this chart, it will very much become a conversation around picking good, solid companies as opposed to looking at the market as a whole. Some other things to watch. So I've talked a lot about the banking sector turmoil. I think we all know what's going on as far as where banks are. Banks are also vital for future economic growth because they're the lending facilities that we all go to grow businesses. How that plays out will directly affect economic growth. It will also affect the banking sector from a whole. When we looked at the sector performance for the first quarter, it hasn't been super strong. The big banks have been relatively unaffected, but when we look at banking as a whole, a lot of questions still out there in terms of signaling potential issues or issues in the plumbing of the financial system because of a rising interest rate environment and now reduced liquidity for some people. So something to keep a very close eye on, and something from an investment perspective, particularly to keep a close eye on, not just for those bank stocks, but also others that are out there that are directly affected by things that happen in the banking industry. The inverted yield curve. So I've thrown this term out a couple different times. Essentially what an inverted yield curve means is that shorter term investments and short-term interest rates end up having a higher rate than a long-term investment vehicle. So for example, a bond. When a shorter-term bond has a higher rate than a longer-term bond, that's what we refer to as an inverted yield curve. Historically speaking, that's been a relatively reliable recession indicator because it suggests that the bond markets is concerned about the economy potentially slowing in the future. What that affects in the short term is, shorter term rates in some capacities can affect. We're seeing it in the mortgage market, for example. Gets tied to the 10-year treasury quite a bit. We're also seeing a lack of investment in 30-year instruments or 30-year treasuries, and also can devalue those. So if you're in a bond fund, for example, that inverted yield curve can directly affect the investment performance of certain bond investments in your portfolio. So those are that's why that's relevant. The economic reason is one that most people, if you turn on any kind of financial media, talk about and pay attention to, but there are other practical reasons to be mindful of an inverted yield curve. So, from a From a historical perspective, the yield curve this is the most inverted that it's been pretty much in 40 years. So this is certainly an extreme example, and one that is an indication that there is a potential economic slowdown and or recession coming. And to the next point, there are mounting recession signals. So inverted yield curve is one of them. Despite the financial market kind of recovering in Q1 because of the resilience of the economy, the risk of recession has still materially risen because of sharp tightening of financial conditions. Ultimately, that's driven by the Federal Reserve, their rising rates that they've instituted. Not just the Federal Reserve in the US, but around the world as well. A lot of central banks are doing this, some more drastically than others. And there's also some other key indicators that have historically, proven that to be signals of recession, or flashing indicators of there's something that could potentially happen. And so all that being said, like, what do you do as an investor in an environment like this where there is some perspective where you could remain optimistic because the market is improving this year in comparison to last year. There is some growth that we're experiencing. Because of that, how do we approach the investment conversation with these signals of recession and words of caution moving forward? So 3 key takeaways from this. These are going to be common themes from conversations that you may have heard us have in the past, or if you haven't, these are things that you can take back and utilize with the relationships that you have in the investment realm. And so the biggest one is staying diversified. I think diversification lost its luster over the past 10 years because diversified portfolios ultimately underperform things like US growth stocks. But when we're in a volatile environment, and when we talk about risk management from an investment perspective, diversification is key. Spreading out your money to make sure that you're not putting all your eggs in one basket so that you don't live and die by one asset class is actually a really effective risk management tool amid all the uncertainty. It's not necessarily going to mean that you're going to have the best performing portfolio when you're talking around the water cooler or you're at the dinner party bragging to your friends, but what it will do is limit the amount of volatility that you experience in drastic market movements, whether up or down. And so diversification has always been key, but probably now more than ever, based on the amount of uncertainty and some of the signals that we're seeing out there in the market. I think there's also going to be a push. I talked about pressures on corporate profits and margins, really pushing towards a resilient portfolio. And what we mean by that is, if you're going to go down the route or down the path of selecting individual companies or individually investing in stocks, you want to focus on companies with strong balance sheets and consistent cash flows. If you're not an individual stock investor, there are still tons of fund managers and different investment strategies out there that exist that do have a focus on this. And so these are things that you're going to want to look for in an investment portfolio, or conversations that you can have with your advisor or portfolio manager if you're working with someone currently. Communication. In our practice, communication is always key, whether the market is chugging along doing just fine, or we're in a volatile environment where there's a lot of ups and downs, or even an environment like last year. I think the important piece of that communication is not, and where things get mixed up with a lot of investors, is they build the investment portfolio as the center of their universe when they talk about planning. And the reality is that the plan itself is the center of the universe. The investment vehicle and the money used to drive that is really just the tool that helps move you closer to that goal or that initiative. And so we call it our living financial plan in our practice, but you really want to make sure that you're doing maintenance of a living plan that adapts with you, not just adapts to the economic or investment environment, but adapts to where you are in your life, and then tooling your investment portfolio to match plan, not vice versa. And so aligning your investments accordingly with where you are, what your philosophies are, how you feel, whether good, bad, or indifferent, how you feel about the world, how you feel about your own financial situation, and what your goals and objectives are really going to drive your long-term success. And it's also going to help with investor behavior. We talked about this a lot in previous webinars, but investor behavior is really the biggest driver of performance. I mean, if you can pick a philosophy, get invested, stay invested, and really stand your ground with that, we find that most investors actually outperform the average, if you want to call it day traders or people that are constantly looking for opportunities and trying to time the market. 9 times out of 10, you as an investor, if you're just disciplined, you can outperform. And so I know I've mentioned this, and some on the call have probably heard it, but I'll wrap up with this. One of my favorite studies, and it's relevant now more than ever, was done by Fidelity Investments, and they wanted to research who are their highest performing investors on their brokerage side. And so they reached out and they said, your account has outperformed everyone else on the platform by X percentage. What have you done differently? And the top 2 groups, or the top 2 answers for the outperforming accounts, were people that forgot that they had an account at Fidelity, and people who had passed away and their family members had no idea that the account existed there. So all that tells us is that our own behavior sometimes can be the biggest influence on the performance of an investment portfolio. And so the key to this is build a plan, make the plan the center of your universe, build your investment portfolio as a tool around that, amongst other financial tools and resources that you're using. And in most cases, barring that you have realistic goals and objectives and expectations for yourself and your ability to stick to that over the long term, that will inevitably increase your probability of success. So I know I talked about a lot today. With that, I'm going to wrap up our section of the presentation. I'll open the floor to questions. We'll stay on for a couple minutes if we don't get any questions, but feel free to chime in, use the Q&A or the chat box. Let us know if there's anything that we can answer for you specific to the presentation, or if you just have general questions kind of about the market or what's going on in the world, we're here and happy to answer. Got an easy crowd today. Everyone's going to get outside and enjoy that beautiful weather. So not a lot of questions, but again, appreciate your time. Like I said, I'll stick around here for a few more minutes, and let me know if there's anything that you want to get addressed, or if you have a question that you'd rather ask offline. Feel free, shoot us an email, give us a call. And if you want more information about our practice and also and what we're doing here at StatonWalsh with our clients, you can visit us you can learn more about us on our website, StatonWalsh.com. And also you'll get a communication after this meeting with a copy of the slides and the video for further review. So we're always here to help. We appreciate your participation, taking time out of your day, I'll shut down the recording now, and we'll just kind of hang out here. And if anyone has any questions, let us know. If not, we appreciate you. Enjoy the rest of your day, your week, and your weekend.